Assalamualaikum. In today's YouTube video, we can discuss the capital budgeting case study. So, our assigned topic is case study of Harris Leffer Company. In this video, we can cover all the questions related to this case study. So, one by one questioning. Question number one: the problem statement. The replacement of old equipment with new equipment, and what cash flow would result for the each of the 5 years from this replacement. So question number two: what are the various investment decisions involved in this project? There are the three type of decisions are involved in this project. The replacement of old equipment, purchase of new equipment, analyze the operation cash flow. The question number three: explain what the new investment and asset disposition decision. The new investment decision involve allocating resources to a new project or asset expected to generate future return. This included profitability, risk, and market condition. Asset disposition decision focus on whether to sell or dispose of existing asset that may no longer be profitable on or needed. This involves assessing current market value and future cash flow to optimize the organization asset portfolio. So question number four: what are the effects of depreciation on tax in the case of new acquisition and asset disposition? Decision. In this case of a new acquisition, depreciation expense reduce tax because depreciation is already a expense. So if our expense is high, we can pay less tax. In asset disposes we can generate cash out inflow. So we should pay on that inflow in the case of gain or capital gain. Question number five: are there any tax credit on the acquisition of a new equipment? No, there are no tax credit on acquisition of new equipment. When you buy a new equipment, you can charge our depreciation expense every year. So, airwise, we can receive a tax shield because of depreciation. So, question number six: is this project a new acquisition project or a replacement project? This project is basically the replacement of its existing manufacturing equipment with the new equipment. Question number seven: how the equipment will depreciated over the life of the project? Explain in the detail the various depreciation method involved in this project. The equipment will be depreciated over their own life, not their project life. So that's answer is our no. There are two type of a method involved in this case: straight line method and Becker's method. In old equipment case, we can use straight line method, and in the new equipment case, we can use Becker's method. Straight line method basically is a cost divided on their useful life, and Becker's method is basically we can charge percentage every year of their depreciation. Here we can see this example in the Excel sheet. So here you can see the depreciation method. The first of all, we can put their cost. New equipment cost 3 lakh and all equipment cost 2 lakh. The life of asset of old equipment is 10 years and life of asset of new equipment is a 5 year. So we can see that here we can see their depreciation process. The new equipment we would charge depreciation as a percentage method, and we can charge depreciation of all equipment with the straight line method. In straight line, we simply divide total life, total cost divided by total life, and in Becker's method, we can take percentage every year of depreciation. So question number 8 is what are the cost implication of the old equipment? Will there will be any gain on its sale, whether the gain will be a capital gain or a capture gain? So their answer is the old equipment cost 2 lakh 5 year ago. So currently the tax base of that equipment is 1 lakh depreciate on the straight line method. As we can see in the Excel sheet how we can depreciation the old asset. We can depreciate the old asset on the straight line method. So the today value is 1 lakh, but old equipment sold on 1 lakh 20,000. So they are the simple gain because we sold this equipment higher than its tax basis. So we can pay their so we can pay tax on the extra on their gain. 20,000 is our recapture of the depreciation, so we pay the tax on 20,000. Now we can say, now we can see this procedure in an Excel sheet. So here we can see the sale of the old equipment. We sell this equipment today 1,20,000. If we sell this equipment after the 5 years, we pay we generate cash outflow. We can generate cash inflow 10,000, and if we sold today, we pay 7,000 tax. And if we sold this equipment after the 5 year, we pay less tax, like this. So question number 9 is there any sunk cost involved in the project? Yes. The 22 lakh old equipment cost is our sunk cost, because which is irrelevant cost. So the question number 10, what are the different cash flow involved related to tax in the case of disposition of the old equipment? Yes, there are two taxes related the cash flow. The selling the old equipment today result is a tax of 7,000 cash outflow, and if the company keep the old equipment and sell it after 5 years for 10,000, there would be has been inflow of 35,000, which is 35% of their future sale price. That's this amount we can see the Excel sheet. And the question number 10, 11 is if the firm replace the old equipment today, what will it forgone after 5 years? If the firm replaced old equipment today, it forgot the sale of equipment in 5 year for 10,000. It also forgone tax inflow of 3,500 on the future sale of the equipment. Question number 12, what yearly benefit the company will earn in the case of reduction in the expense when the new machine will be inserted? The new equipment expected to reduce production cost by 60,000 each year. Now question number 13. Why there is no effect on the revenue due to a change in equipment? In some cases, the installation of a new equipment may not affect cash flow. It depends on the specific financial circumstances. To question number 14. Explain the depreciation tax shield reduced by the company due to investment. Basically, depreciation tax shield received when over expenses high. So is that case, uh, if our expenses increase, so we pay less tax. So that's why depreciation give us tax shield. So question number 15, how manager practically make important investment decision? They estimate cash flow based on factors like sales, expense, taxes, and working capital needs. The question number 16, what are your key learning after reading this case study? We learned this point. We learned many points, but we can mention here it 4 point: the case disposable process, case acquisition process, the tax basis, and depreciation mindset. Here we can complete all the questions. Thank you.